Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It's Monday, August 13th, 2007, and the market has just closed. The S&P 500 did manage to finish with a gain of 77 cents, or just about a half a percent. But as you can see by this red candle, the open was lower than the open was higher than the closing price for today. The S&P 500 opened at 146.50, and here we see the close a dollar lower at 145.49. So intraday, the sellers were in control of this market, and that shouldn't be as a surprise to anyone with a declining 50-day moving average. No one is bigger than the market, and that includes the Federal Reserve. If you look at the chart that I posted last Tuesday about how effective are changes to monetary policy, no one is bigger than the market. They can affect it for a few days, inject some confidence, and stave off a panic, but I think it only delays the inevitable, which this declining 50-day moving average tells me lower prices are inevitable here. Now, it seems to be struggling still with this 200-day moving average, and that's got a lot of hopeful bulls left in this market. But from a shorter-term standpoint, with a declining 50-day moving average, you've got to look at the sellers as in control of this market on the daily time frame, and any and all rallies are going to be highly suspect. If we look at the 10-minute time frame, you can see in here that what I'd said on Friday was that basically, because we've got these moving averages crisscrossing, they were more neutral than anything, and I still think that's the case. If you look at, this is just a big mess since the over the last couple weeks. Hard to really decipher any true trading pattern, which tells you ought to be focused on the shorter-term time frames. Once again, I'm going to point out from this point right here on the 7th, when the Federal Reserve met last Tuesday and didn't change monetary policy, we saw the market rally, and this is a VWAP line that I'm showing you right here. The VWAP line, if you drag it directly across, the average price the market is S&P 500 has changed hands since that meeting is about 146.85, and that's where we found some resistance today, as well as the location of that 5-day moving average. Now, the 5-day moving average looks like it's heading lower again, but it's really just back and forth in here. The key level in this market, I think, is going to continue to be around that 143 level, and until it breaks down below that or up probably above this level, we're going to be in a trader-oriented market, and there's nothing wrong with that if you're a trader and you know how to handle the risk associated with it. Markets seem to be holding up for most of the day, but late in the day we did get some selling off, and I think that came with the continued weakness in Goldman Sachs. You can see that this stock, Goldman Sachs, gapped much higher today, up near 185, 186, but that gave back $9 from that high. Goldman Sachs is in a downtrend. To me, any long purchases in here are foolish. You hear don't throw good money after the bad. That's exactly what Goldman Sachs is doing in here by injecting $3 billion into a fund that's down $3 billion. It's not easy to say goodbye to a bad trade, but they've clearly got a bad one here, and the market, if it's correlated to the market, which it seems to be, it seems like they're making a bigger mistake here, but that's not for me to judge. The market will eventually tell us. But what the market's telling us right now is that they don't believe it's a good bet. They're betting against this stock and getting rid of the shares of Goldman Sachs. And maybe Goldman Sachs is finding some support in here, but I definitely wouldn't go near it from a long trade. I would not, like I point out a lot of times when these big hedge funds fail, just because you're big money doesn't mean you're smart money, and just because you're Goldman Sachs doesn't mean you're not going to make mistakes now and then. The semiconductors, I've been saying in here for the last week or so, have been really more neutral on the daily time frame and on the short-term time frame. I continue to believe that's the case. If we're to see a break below $37 a share, then things could get ugly once again in the semiconductors, and perhaps we're going to go down to that 200-day moving average down at about 35.80 or so. Still a lot of danger in this market. That's the key to walk away with. The IWM, these guys were showing a little bit of stability last week, tested that 200-day moving average and found resistance. This morning, same thing. We got another test of that 200-day moving average, and there are sellers there at that $80 level. And when it gets up there, it's met with selling, and this morning it gapped higher into that range, and it came back down, closed right near the lows. Not a good sign for this market, although, again, on the weekly time frame, we're at an area where there might be some support found. However, with the damage done here and the declining 50-day moving average, it's definitely not a reason to sell. I mean, to buy because it's at a potential support level. potential support level is great, but it's how that level actually acts. It continues to be a trader's market in here as well, breaking back below the 76 and 76.40. I think we're going to see a retest of the lows, and a retest, typically brings them just a little bit lower than that. So continue to be very careful. The Nasdaq 100, this market can't. We've had 3 days closing below the 10 and the 50-day move, 10, 20, and 50-day moving average. If you have the 10 below that 50, the 50 is starting to flatten out a little bit, and it looks like this market, the best potential support is down near 46 bucks a share. That's still $1.60 away, and I think if that was to be tested, you'd have to throw in a token test of this 200-day moving average as well. So there continue to be a lot of problems in this market. If the Qs are to get down to that 200-day moving average, at 46 and the 200-day moving average, then here's what would happen to the QUID, the QID. This is the ultra short fund from ProShares, meaning that when the NASDAQ declines 1%, these in theory should advance 2%. That would get these up to from 46.11 right now to 49 to the $50 level. So that's one potential way to play any such weakness if it does develop. The key level in here, I think, is going to continue to be $47 a share. Breaking below that $47 could open the floodgates and get us to at least test these lows. But I think if we got that test, that this level would fail pretty quickly. And looking at today's action, on a 2-day time frame, you can see we broke that uptrend line, and then we just kind of got a weak close, but very uneventful day in here. Looking at the 1-minute time frame, just a big mess here with this VWAP. But overall, traders market still continue to be very defensive.